Welcome to the Backtest Lab. Let's look at the data. Imagine putting together a trading team, but instead of hiring finance bros, you hire the smartest mathematicians on the planet. You hire two economists who literally won the Nobel Prize for inventing the mathematical formula used to price options contracts. In 1994, this team launched a hedge fund called Long-Term Capital Management, or LTCM. Their strategy was not based on guessing where the market would go. It was based entirely on high-level mathematical backtesting and a concept called convergence arbitrage. Here is how it worked. They would find two assets that usually move together, like a 30-year treasury bond and a 29-year treasury bond. Occasionally, because of market inefficiencies, the prices of these two nearly identical bonds would drift apart. The LTCM algorithm knew that eventually logic would take over and the prices would converge back together, so they would buy the cheaper bond and short-sell the expensive bond. It was a perfectly hedged delta-neutral trade. It did not matter if the overall market crashed or skyrocketed. As long as the two bonds eventually matched prices, the algorithm made money. The system was practically flawless. The backtests were perfect. For the first 4 years, they generated massive, consistent returns of over 40% per year. Wall Street considered them financial gods. They were managing over $4.7 billion of client capital. But there was a hidden flaw in their data, a blind spot in the backtest that would soon trigger one of the most violent financial collapses in history. The problem with convergence arbitrage is that the profit margins on each trade are incredibly tiny. To make billions of dollars on tiny price differences, LTCM had to use leverage, massive, unprecedented leverage. At their peak, they had borrowed so much money from banks that their leverage ratio was 25-1. That means a mere 4% drop in their portfolio would completely wipe out their entire equity. But the mathematical models said a 4% drop was statistically impossible. The algorithms calculated that the absolute maximum they could lose in a single month was $35 million. Then came August 1998, the Russian financial crisis. Russia defaulted on its government debt. This was a black swan event, an anomaly so rare that it was not included in LTCM's historical backtesting data. Global markets panicked. Investors completely abandoned logic and mathematics. They sold everything and rushed to the absolute safest assets they could find. The price gaps between the bonds that LTCM was trading did not converge. Instead, driven by pure human panic, the gaps widened to levels that the Nobel Prize-winning algorithm said were mathematically impossible. Because LTCM was leveraged 25-1, the algorithm started bleeding cash at a terrifying rate. On a single Friday in August, the fund lost $553 million. The mathematical models were broken. The smartest guys in the room were margin called. By September, LTCM had lost $4.6 billion. They were literally days away from complete bankruptcy. Because they had borrowed hundreds of billions of dollars from every major bank on Wall Street, their collapse threatened to take down the entire United States financial system. The Federal Reserve had to step in and organize an emergency bailout just to prevent a global economic depression. So, what is the lesson for us in the Backtest Lab? Why did the greatest quantitative algorithm in history fail? Because of two things: over-leverage and the illusion of perfect data. LTCM forgot the most famous rule in finance: the market can remain irrational longer than you can remain solvent. Their backtesting only looked at normal market conditions. It did not account for pure, unpredictable human panic. When you are building your own trading systems, you cannot just backtest for the good times. You must stress test your strategy against the worst possible scenarios. And more importantly, you must respect leverage. A high win rate strategy means absolutely nothing if a single black swan event can margin call your entire account. Data is your edge, but risk management is your survival. If you want to learn how to build automated strategies that actually survive market crashes, hit subscribe. See you in the next breakdown.